Welcome back. Today, session number 8, dated May 17, 2026, part number 20. This is we continuing our next adjustment in while doing the computation of corporate tax. The fifth adjustment out of eighth adjustment. So again, the principle will remain same as the continuing. Eighth adjustment, unrealized gain and losses if election made. The word if election is made, from the other side, the reality will remain there. Reality will remain there. Even election is not optional. This election is not optional, is mandatory. And you will cover the next. Okay, this is mandatory. So what is our fifth adjustment? Unrealized gain and losses as per Ministerial Decision 134. If election is made. But before diving into that, we have to understand what is that unrealized gain and losses. As commonly we understand the fundamental implication of the concept of the point, then we will go through with the implication of the relevant article or ministerial decision. So here the ministerial decision is 134. Now the first assumption is saying if election is made realization basis, what will happen? So, but my point is that let's understand the election. I think in the last session also we have the basic understanding of the election. So one of the election is the realization basis or unrealization basis. So as the election is giving us two options, realization and unrealization. So now first we have to understand what is the election. We mostly are commonly seen the cricket match or the football match. Mostly, I take the example of the cricket match. Why? Because it's commonly most of the people are familiar, and the example that we're gonna fit here that may be relevant. Let's say any cricket match. I'm not sure some series and worldwide going on, or some PSL or the Indian some matches are still continuing. The national level, some tournament are there. So let's say that if the cricket match, the toss is made for the cricket match, both captains are there, team A and team B. Both captains are there and the referee is there. They will go in ground and they make the toss. When they make the toss, so of course, any one of the captain, he will say head or tail. If any words say head and tail, this is the two option. One of them they have to opt. Be active and be with me to understand the election. If we take any cricket team, A and B, A may be India, B may be Pakistan or Australia, or any New Zealand, or any part of world. So any team, we are saying A and B. So if A called when referee asks any one of them, he will say, okay, head. But the outcome will be tail. Okay. The outcome may come as a tail. So now the discussion point is that this is the election. This toss is the election. What is the election? Who will bat first or ball first? Now just imagine this referee is a FTA. He's giving this option. You choose either you want to bat first or the ball first. So if they opt the ball for the batting first or bowling first, based on what? They will look into that, the previous history of the particular ground or the pitch. They will look into the weather forecast. Now, these are the common that we are familiar, because if anything get changed over here, so it have the implication. If there is a rain, weather is there, because up to certain level of the rain, they will continue the match. Okay. And the before match is there rain. Okay. Still rain is stopped, but some part of the rain is there, 30-minute rain is there. So then the captain who win the toss, he may go for bowling first. Why is going to bowling first? Because he know the implication. He know the implication because due to rain, the ground is wet and they hit the ball and ball will become wet. And pitch have the some water. So is difficult batting condition is difficult batting condition. So I'm not saying anything is not possible. I'm saying difficult batting condition. So hope the scenario you understand. Our election have the implication. If we choose to ball first and the batting first based on other factors, what the previous history, what is the pitch behave in the past, weather condition, then we have to see another important part, then we have to look inward, look inwards. What does that mean? What is the our capabilities? What is the our strength? While looking all these factors, this factor, we have to see whether we are good in the batting or whether we are good in bowling. We have to consider that also, whether we are good in batting and bowling, whether we have the capability to handle this weather condition and take the pressure on the bowling team or the batting team. Normally, we see in Indian cricket team, they have strong batting. They have the strong batting. Indian cricket, they have strong batting. Wherever the choice come, they will put batting team up front. They put batting team up front, the pressure they will bear on the batting end, not on bowling end. So which means this internal capability is also important while looking all these other factors, because this election, this toss is have the associated consequences. We handle from our batting side, we handle from our bowling side. So far, I just make the base to understand the election, how it will be react. So this internal capability is our accounting. Internal capability is our accounting team. Okay. So this decision here is the election. Now, if we win head and tail means maybe we go for A and maybe we go for B. There is a two election and both have same, like if you go bowling first or the batting first, both have the implication. So we have to see what is this. So what all this, what we are discussing, this is a business condition. This is the business facts and figure. Facts, which kind of business activity you are carried on. Okay. So based on that, which election is suit for you? There's a no rule of thumb. We have to understand what are the business activity we are involved in. Then we have to see what is our strengths or the accounting team, how we can handle go with bowling first or batting first. So each side, if we go A and B, both have the implication. Hope this point, the basic fundamental you understand. So I called here the election. This election is here. Then we said if we go the option A, the batting, okay. So it might be unrealized. If we say the bowling first, it might be realized. So now each side, the consequences are there. Now let's see what are the election. So I try to give you the overall concept while diving before into the election of the realized and unrealized. Okay, so now if we made the election, realization basis or unrealization basis. So if we make the election, then we have to see, okay, whether our industry is suit for this or no. Industry mean, let's say we take the any uh, consumer goods, FMBG, we normally the fast mover consuming goods. Okay, and what are their business nature, like the inventory? Inventory is one of the common item because mostly they are dealing in the fast moving consumer goods, FMBG. Okay, if we are involved in this business, so at the year end, at the year end, at the year end, we will have the huge inventory. At the end, we have the huge inventory stock, right? So it's a material amount. I'll instead of huge, we can use the word material. In accounting language, we use the materiality. So material inventory stock. If we have material inventory stock, what auditor will ask? Auditor will ask, you have the, let's say the 100 million inventory stock. What is the provision? What is the provision over here? Provision for slow moving inventory. If you make the provision for slow moving, let's say he made the 20 million. So balance is the 80 million. And this 20 million provision for slow moving stock, where he will hit? Where he will hit? And the profit and loss. Okay. And the profit and loss is 20 million. So let's say if you have the 50 million accounting profit plus this adjustment is came up. So you have 30 million. So your profit is reduced by 20 million due to this provision, due to this provision. Now this provision is realized or unrealized? Now they understand realized or unrealized. So here's the important thing, when actually event is happen, actual event is happen. What is the event? Sale, disposal. The normal course of action, actual event when we sold or when we disposed of In case of 20 million, slow moving, we didn't dispose. This is just provision by auditor is taken. It's not actual event, right? It's just estimate. So this is called unrealized event. Because actually this loss did not happen or incurred so far. It's just the provision based on the expected outcome. So if the estimate or forecast, this is called unrealized. So this is called unrealized. Hope you understand the unrealized. So if this is the unrealized, so now if we opt the election, I'm going to use the word realization basis as a and unrealization basis as a B. If we opt the election for realization basis, okay, so then what we did, I said the realization basis. Realization basis election is made. So this is the accounting profit. Which one is accounting profit? Here, our starting point towards the tax computation. How much? 30 million. And we opt the election A, realization basis. When we come in the financial, we seen this provision for slow moving inventory is already there. As the outcome, our taxable income is reduced. Add back 20 million. It will become 50 million. Earlier, if we are paying at 9% on 30 million, now we are paying 9% at 50 million. As the outcome, our tax is higher. As the outcome, our tax is higher. Any questions so far? Any questions so far? Okay, there's the one question. Okay, that is a later party. We'll come back on the later party. Okay, so here, be with me on this topic. We will come to your question also. Guys, up to here, you understand what is the realization. We said we opt for the realization basis. And this 20 million as a provision, what we recorded, 20 million as a provision, what we recorded. This 20 million provision, what we recorded, we minus over here. It reduces our tax effect. This is not the actual event. This is provision is not the actual event. This is just estimate, which means this is the unrealized event. If it's an unrealized event and we opt for the realization basis, if we opt for the realization basis, so whatever unrealized event that we have to adjust. Adjust mean earlier we did minus, now we have to add back. So as the outcome, we are paying the more tax. Outcome, we will pay more tax. So, but important part, we understand, we learn that what we learned that realization and unrealization and what is the implication. So if such industry, if they opt for realization basis, they have to pay more tax. So as a just understanding for them is unrealization election is maybe best. We using the word maybe because we are looking only 1 point. 1 point. Okay. Earlier we discussed in the example, we have to look the business overall framework, our internal capabilities. Now the internal capabilities, we did not look into that. Okay, so if we use this realization basis and while computing the tax we have to add back, then our accounting team must be strong to record in a proper way. They give this adjustment to the tax internal tax manager or the tax consultant because at each item, the inventory level, they record this traceability because they have to provide this ledger. Okay, this is the what provision we made. This is internal capability. Capability means your scope of internal team is increase. We have to keep eyes on this. From which ledgers, which inventory item this amount is coming and why is coming. Okay, maybe the company organization is dealing more than 10 items, 20 items. So if we do this adjustment, you have to increase your working. This is the in accounting team effort or the capability will be enhanced. The same way if they use the unrealization basis, same way if they use the unrealization basis, so whatever is here is good. We don't have to go with this adjustment. This is the unrealized event, and we use unrealization basis. It's good to go. Continue. We don't have to work this adjustment add back. Accounting team do not have to bother about this. Whatever is already done in accounting system, it will be carried on that basis. So this will be good unrealization basis for the accounting team because their amount of work is less. But on the other side, we have to look into, okay, if current scenario accounting team is favorable, for business owner also favorable because they are paying the less tax. They are paying the less tax. Both are suitable on going on unrealization basis. As a limited view, I'm normally say the limited view. Why? Because each organization, each business is a different. But we understand the unrealization basis, unrealization basis. This was the our important part. If any question, please. Here we said if election is made, we already understand the realization basis. So if we understand the realization basis, the less gains if already added. Okay, if we opt for realization basis, if the gain is already added, we have to minus. If we added the losses, is already deducted, we have to add back. Opposite adjustment we have to make into our city return. We are continuing with the same point. So fifth adjustment on realization basis. So here we're gonna understand the realization basis sold. Realization basis sold. Unrealization basis unsold. What does that mean? Realization actually sold, unrealized actually not sold is just estimate. So this the note transitional gain and losses. The realization gain and losses and transitional gain and losses both are not same. Both are not same. Transitional gain and losses and this is normal course of action during the business. This is the first tax period, transitional gain and losses that we will cover it separately. But just as a common question as per the previous also we've seen, we are just trying to add over here. Under accounting, see, the realization and unrealization under accounting, under accrual accounting, we are using the fair value model, revaluation model. Okay. Revaluation model, recording asset plus liability in the financial statement at market value. So under accounting, accrual accounting, we're using the fair value model and revaluation model. Why this note is here? See, now if we come up with the IFRS, because law is not saying anything, so he's saying, okay, go as per IFRS. So IFRS also giving us the two treatment. And law taking the his own action based on both treatment. If we did on fair value, he's defining the different set of rules. If we go revaluation model, he's defining the different set of rules. We will learn in the detail this example, what will be the implication and what is the revaluation model implication. With the example we covered in the first batch also in the first quarter 2025. Of course, we're going to cover here with more detail also. Election required in the first tax return. This is one of the important part. sum of the election is irrevocable and is required in the first tax return. It is the same way if we playing the cricket match, first the toss will happen, then they will choose for the batting and bowling. And once you made the toss and you take the decision, you will go for the batting first, and you come back in your with team and say, okay, no, no, I don't want to go batting first. We will go ball first. Normally, this is not the case. Whatever they opt, they will continue with the same. So here the law is saying in the first city return and is irrevocable, mean this is the lifetime. Lifetime for easy understanding, law go as irrevocable and irrevocable. Now the first is saying if no election is made, by default will be there is a election. Even you are not choosing, by default when you go with return, the election will be there. If no election is made, pay city on realization basis, which is also irrecoverable. Of course, when you file the return, if you there is option called yes or no. By default, option will be yes, maybe. If we say yes, proceed next step, next step. So again, this is the election. You didn't choose, but by default, you said yes and proceed next step. So it will be marked as a election. So this is the meaning what we are trying to explain over here. No election means because you are not familiar in the many in the market we've seen during the first return, many city return filed without election. They're saying we don't know what you're talking about. So that doesn't mean election is not there. You are not familiar. You just file the return without knowing, without calculating the effect of that realization and utilization. But that doesn't, if we don't know or if we're not aware, the law will not change. Law will remain there. This is the on all the organization, and it's whatever the situation, it will be irrevocable. If yes, election on realization basis made have two options. Now we're saying here we didn't opt, we said on realization basis by default. Okay. But here we're saying yes, election we wish to make, then we have the two options. What is that? Revenue, unrealized gain and losses adjustment in city computation. If we say yes, then we have the two options. We will see after this the actual tax return also how it looks like. Okay, here we coming the two options. The first important part is the two options. Then what with the two options? Okay, the first two option is the election A. Under election is A, if we opt for that, all asset will be on realization basis. What does it mean on all asset and all liabilities? Commonly we know the current asset or liabilities are the other non-current asset and the liabilities, right? So when they talk about all means current and non-current both are there. So now here we said two options. So first option, all asset and all liabilities. Okay. Non-current asset and current asset. This is the definition of all asset. Current asset, non-current asset. So now further we have to understand what is the current asset. We already know being an accounting profession, what is the current asset? Short revenue item, short-term item, like the stock revenue, stock and inventory. Just before this slide, we covered the inventory as a FMBG, fast moving consumer goods. Okay. So we covered the stock and inventory under the current asset. So what is the non-current asset or the liabilities? Long-term assets. Long-term, what is that? Land, building, plant or machinery, investment property. These are the long-term. Normally we are familiar as per the IFRS guideline is more than 12 months. If the economic benefit coming more than 12 months, we are classifying as a long-term and non-current. So here we understand current and non-current. When we talk about the election A, we said all asset in which coming current asset plus non-current asset. So now let's see the second option, election B. Here we said or we have to take one. So election B, there is no election B mentioning the city return, but as a understanding, we are categorizing into two election. Okay, there will be mention all asset and liabilities. This is the return. Okay, city return like that. City return like that. So now here we understanding that election B only capital item, long term. Okay, long term asset. So this is the long term asset, right? He's saying okay, keep current asset on unrealization basis and choose for election realization basis only. Why are they saying okay? Normally certain businesses they don't have the nature of the business is not affected due to revenue item like the stock, like they don't have the stock. Let's keep the focus on the stock. If at the year end they don't have the stock or their stock is not fall under the provision, if like the trading business is falling under that, we have to evaluate and let's see if we are not getting effective due to the stock and there is not much difference. So accordingly, we can look into the election B also. We're saying if the asset or the plant we sold, if asset or plant we sold or the increase and decrease in value, that will have the huge impact in the profit and loss. Okay. Why the plant? Again, due to fair value change. Let's say due to fair value change. Okay. Normally the properties, buildings. Okay. We add into our books. This is unfair value means we took the valuation from the market and we said, okay, earlier our property value was 100 and after the valuation is 120. So now 20 million is added, but this is the unrealized. If we offer the election B only, so he's saying whatever the gain coming from here, okay, it will be not taxed. We will, if we add it in the accounting, we will minus. Why? Because we said once actually sale happen, then we will pay tax on the actual gain. So this is the election B, only capital asset on realization basis. Here all asset on realization basis. By default, if we saying capital asset mean the revenue asset is on realization basis. We opt only for one, other by default will be go on realization basis. Like here, they took the example for 120 million for the plant or building. 20 is unrealized gain due to change in market value of the business. So let's say inventory. This will be, because it's a gain already added, we will minus from the taxable income. But if here the inventory, we have this slow moving provision, 5 million, okay. Slow moving provision, 5 million, already minus from accounting profit, do nothing. Because we didn't opt whatever the, by default is a unrealization basis. Oh, sorry, by default is the realization basis. Okay. This one will be on realization basis. So we'll do nothing. Whatever the accounting profit, we carried on with the same because this is on unrealization basis. Whatever the effect in the accounting profit will continue with the same. Any question so far? Let's understand this small example with the property. Property asset market value, net book value is at 10 million. Okay. Now here's the two scenario. First scenario is if market value, keep in mind, market value is at 10 million. First scenario is if market value is 15 million. Under that, under accrual accounting, we have gain 5 million. This is the based on market value, is not based on sale. So this is the unrealized profit recorded in the profit and loss. But city law stating make election, do you wish to pay the tax now? Okay. We have the this profit, this gains 5 million. So now the city law is saying, do you want to pay tax now or in future when actual sale is happen? This is the definition of election. If we saying, okay, realization basis, because this is the unrealized, it's not actually came, okay, it's actually not came the funds into our bank accounts. Just another way of understanding. Unrealized is just the number in our financial statement, but actually in our bank didn't hit. This is the unrealized. If realized means actually fund hit in your bank account. Another concept for understanding. So here we have to take later on actual upon sale. So based on this election, this adjustment will be made. Market value, this minus this, gain is 5 million. The second case, this, let's take the A, and this is actually B, and this is the B. And second scenario, market value 8 million. Oh, sorry, the net book value is 8 million. Oh, sorry, 10 million. Net book value, what is the net book value shown in our balance sheet? Okay. And market value is 8 million. So total loss is 2 million. So based on our election, this adjustment will be added into our books of city return. What are the possible scenario where this adjustment may come? Okay. Fair value change, yes. Impairment loss and gain, receivable expected loss, IFRS. So again, this is the receivable come under the financial instrument and is dealing IFRS 9. IFRS 9. Provision, okay. Normally important factor is that normally the provision for doubtful debt is not falling under that. Not falling under realization and unrealization. The important point, as per the FTA guideline, one of the public clarification, they mention provision for doubtful debt is not hitting over there under this realization and unrealization basis. This is the normal course of action. So it will not fall under that. But impairment loss and gain fall under this provision. The yellow highlighted just provision do not fall under this election. Okay, now let's see our return, how it look like when we talk about the realization basis election. How it look like when we talk about realization basis. And this is a return screenshot election realization basis taxable person like to elect to use the realization basis? He's saying yes or no. Okay, if we didn't opt, by default will be no. Okay, by default, here is the one box like this. Okay, now if we're saying yes, we will choose this. Then the next question will say, okay, are you taxable person as a bank or insurance provider? We will say no. Why? Because the rules are different for them. Okay, if we opt for the bank or insurance provider, the rules are different. But normally course of action, we will say, okay, we are wish to opt, then we are not, then below two adjustment. Okay. Would the taxable person like to elect for realization basis? Okay, he's saying we opt for yes. Now he's saying all asset, or here he's saying held on capital account. All asset are subject to fair value. Here is saying held for capital fixed asset. Here is the current plus fixed asset, both current and non-current. Here is the non-current only. Based on that, again, the treatment will be changed. This is what we are discussing in the example of the cricket match. Okay. So we have to see what are the our strength, what are the circumstances. We are strong in the batting. So we are strong in the bowling either way. Or what are the ground reality, past, or the associated factor, the weather condition. So our business affected due to this election or not affected. We have the accounting team who can work extra and go for the eliminate the unrealization basis. If we don't have the capability, if we don't have to spend the more time, so okay, everything will be on unrealization basis and continue until unless it's material amount for the your business or the industry or for your client. So here the realization basis, when I said the consequences, the additional consequences will be shown here. Now the saying, has been there any unrealized gain or losses in accounting in the current period? Because we have to calculate and add over here. Whatever the adjustment we have in the accounting record, but we don't want to continue with that. So after saying, give me the adjustment. Adjustment to the depreciation which increased taxable income in respects of the asset which subject to realization basis. Now the depreciation, if we look and you'll say, okay, how come the depreciation adjustment will be there? Of course, when we come on the realization detail exercise, we will see the example how the depreciation is getting affected. Okay, just as a common general example, if the book value is a 10 million and market value is a 20 million. So the difference is a 10 million. So the depreciation will charge on the now 20 million. Okay. Now, if I start with this, another question will start coming. So I just give the basic understanding. So how to charge the depreciation on this 20 million? It will go on fair value or market value or a revaluation model, how it will be go. So accordingly, that amount FTA is saying, okay, now this is enhancing the accounting team work. More burden coming on accounting team to calculate and give to the tax consultant or the auditor or the whoever the concerned person doing the return filing. If you did not notify to your tax consultant or the internally, so there will be error. He opted the election, but this adjustment is there because the accounting team is not familiar. So accordingly, they did not highlight. The limitation of the auditor and the consultant, they cannot go 100%. They go on the management information and the sample-based assessment. So that is the inherent limitation of the when we talk about audit, when we talk about the consulting, because they are not the 100% activity owner. As good as your accounting team, your compliance will be more compliant. Adjustment to the depreciation decrease. See, mostly he's saying due to any adjustment is an increase, give us separately. Any adjustment decrease, give us separately. He's saying the depreciation adjustment moving up, give a separate figure. Maybe you have five properties. Okay. P1, P2, P3, P4. If you have four properties, maybe these two properties, depreciation increase 5 million. And here the two properties, due to their depreciation, decrease by 2 million. Increase in 5 million, decrease 2 million. But how we are recording in the same ledger, so net effect coming is 3 million. So now we should not put this 3 million. He's saying put the 5 million here and 2 million here separately. You need the information each transaction wise up and down separately, not netting of figures that normally we are recording in our accounting system. Here earlier also we discussed if such scenario are there, so please make two chart of account that will be easy for the traceability and the understanding while pulling the data from the system or the trial balance. It by default it will highlight whenever come the plus, you record here, minus here. Some student will come and say, okay, we still can split and take the figures, then it's manual work. Yes, you can do, but if you forget about that, it's a manual work. Increasing your scope, increasing your activity versus if you configured properly chart of account, that it gives the more accuracy and reducing your manual work. See, now if we still relying on our memory and putting the pressure on memory, okay, at the year end, I have to do this adjustment. After 12 months, I have to do the adjustment. Versus I'm saying, fix your chart of account, as of today. You should not keep burden on your mind. I have to do the adjustment after year end. Do it today at transaction level. It will give you relief. It will give you the relief and it will give me more accuracy or more compliant way to later on, because this accounting record subject to audit up to 7 years after the tax period. Okay. So after 7 years, maybe after 2 years, you are not with the same business. So you made the Excel calculation and given the figure to the tax consultant. So after 2 years, you are not there. FTA came for audit. Who will be liable or who will be helpful to identify tracing that figures? No one will be there. Ultimate, who will suffer? The business owner will suffer because the new person don't know what happened the 2 years before. And the person who did this exercise is not a new. We were in discussion one of the activity with the multinational organization. Uh, I cannot take the name of that. So when we ask about the further details, so they said, okay, this transaction did in this was the VAT scenario. The team who was there before 2 years is not anymore with us. We cannot give you the detail of that. When we are shocked, the corporate level, the multinational organization giving us this response. Whereas these are the standard documentation, it must be kept somewhere, must have the detail or breakup. After 1 month, they given the same answer. They said we could not very able to trace that information. Then they said, okay, you have to work on that and give us a solution on that. Okay, if I'm thinking from the tax consultant point of view, as a consultant point of view, this is an increase in scope. It's good for us to getting the new scope and adding the more resources and generating the revenue. But always this is not the good for the business owner. If we kept the record from the day first in appropriate way, you will maintain the sufficient documentation. Even regenerate that information may be not 100% reliable or accurate as the original. Because the facts and figures, scenario, and the person who's actually engaged and handling, he knows much better. Any of them. Next, other adjustment in analyzing, okay, any other adjustment, decrease, the word is decrease, here is the increase. He's again saying the separate. If any other adjustment, that also have to report separately, not the netting of figures. Any question, dear, please? We covered the intra-group transaction, we covered the transaction with related part, we covered the unrealized gain and losses if election is made. So this is all the same. Natural person we covered under the transaction with related party, natural person, officer, ministerial decision. Okay, then we juridical person, branches, fourth degree. Then the unrealized, this is our third adjustment that we covered, election made, what will be the implication, the return in the first tax return, irrevocable. This, I'm just summarizing what we covered in the three session. Election made, what is the implication? Election A, what are the implication? If election B, what will be the implication? So this is the quick recap of these three parts. Then election made B, so what will be the consequences? Then we have the example. So far three adjustment we covered. So any question belongs to that. So we're gonna address that before moving to our next adjustment. This is the local dividend. This is the also we covered under the previous. So I'll just skip this part quickly. Okay. So now here, before starting the next, we have to quickly see that if any point from your side.